Let's talk about risk in investing. But how do you really measure it? Today, we're going to toss out the old rulebook. We're going to explore a tool that gets right to the heart of what risk actually feels like. You know, that knot in your stomach when you see your portfolio take a nosedive?
No, really, take a second. When I say investment risk, what's the first thing that pops into your head? Is it some number on a spreadsheet? Or is it that gut-wrenching feeling when you log in and see a sea of red? The standard ways we measure risk, they just don't capture that emotional gut punch, do that?
So here's the deal. The big problem with how we usually talk about risk is that we lump everything together. But there's a world of difference between price swings that make you money and the ones that lose you money. And believe it or not, the most common tools out there, they often can't tell the difference.
And this is where things get, well, kind of ridiculous. The most common risk measure, standard deviation, treats a massive spike up in your investment's value, that's the good stuff, as equally risky as a terrifying plunge down. I mean, come on, how does that make any sense for you, the investor?
Yeah, you heard that right. When you use these old school metrics, a big, beautiful upward move actually makes your investment look more volatile, more risky. It's a system that literally punishes an asset for performing well. It penalizes you for making money. Surely there has to be a better way to look at this. And thankfully, there is. What if instead of measuring all the ups and downs, we could just ignore the good stuff? What if we could zero in and only measure the bad volatility? What if we could put a number on that investor pain we just talked about? Well, that's exactly what the Ulcer Index was built for. So this thing was cooked up way back in 1987 by Peter Martin and Byron McCann. It has one single brilliant mission: to measure downside risk. That's it. It completely ignores the happy days when your stock is going to the moon. It only cares about the two things that give us all heartburn: how deep a drop is and how painfully long it takes to climb back out. And you don't have to take my word for it. Peter Martin, one of the creators, put it perfectly. The key phrase here is the squaring effect. That's the secret sauce. It means the index doesn't just see a big drop, it magnifies it. It punishes those really brutal stomach-churning drops way more than the little everyday dips.
So how does this pain barometer actually work its magic? Don't worry, you don't need a math degree for this. We're going to skip the heavy formulas and just walk through the simple common sense logic behind how it generates its score.
Okay, first, the index looks at a specific time frame, usually the last 14 days, and it finds the highest price point. Then, it measures every single dip from that peak. Next, and this is the genius part, it squares each of those drawdown numbers. So a little 2% dip becomes a 4, no big deal. But a scary 10% drop, that gets squared into 100. See how it amplifies the pain? Finally, it just averages all those magnified pain numbers and takes the square root to give you one simple final score. And the best part is, understanding the score is a piece of cake. A high score means lots of ulcers. The investment has a nasty history of deep, long drawdowns, a really stressful ride. A score close to 0? Well, that's what you want to see. It's been smooth sailing, just climbing steadily without giving investors a heart attack along the way. All right, time for the main event. In this corner, the old champion of risk metrics, standard deviation. And in this corner, the challenger, the Ulcer Index. Let's put them side by side and see why one is a much better tool for measuring the kind of risk that actually keeps you up at night.
Okay, let's break this down. Standard deviation measures all the wiggles, up and down. But the Ulcer Index, it laser focuses only on downside risk. Standard deviation treats up and down moves the same. The Ulcer Index only cares when the price goes down. So the bottom line is simple. If your main goal is to, not lose your shirt, the Ulcer Index is just a way smarter tool for the job.
Okay, this is all great in theory, but what does this actually mean for your portfolio? How can you actually put this thing to work? Let's get practical and see how this moves from being a cool idea to a real tool in your investing toolkit. First off, you can use it to compare investments head-to-head. Got two ETFs that look similar? The Ulcer Index will tell you which one truly offers a smoother ride. You can use it to screen out stocks that are just too much of a roller coaster for you. And maybe most important, you can find a portfolio that actually matches your personal tolerance for pain. You can even use it to calculate smarter risk-adjusted returns with a metric called the Martin ratio. Let's look at a real-world example to make this crystal clear. Here we've got a Fidelity tech fund and a Fidelity health fund. Now the tech fund might have some flashy returns, but look at that Ulcer Index score,
4.71. Ouch. Now compare that to the health fund, sitting at a much calmer 3.24. This simple number tells you that the journey with the health fund has been a lot less stressful. For anyone who values their sleep, it's pretty clear which one offers a better ride for the risk you're taking.
And really, that's the whole point. The Ulcer Index gives us a totally new language for risk. It's not some abstract concept anymore, it's a measurable quantity of potential pain. So the final question isn't just about what the market is doing, it's about you. Now that you can actually measure it, how much of that pain are you truly willing to put up with to get where you want to go?